Gold is coming under considerable pressure on Thursday, a move that actually started ahead of the US economic data releases and a move that accelerated after them. We saw two pieces of data really that was particularly notable today. The US retail sales figure showing a rise of 0.7% in monthly retail sales. This was against expectations of a drop of 0.7%. And the Philly Fed Manufacturing Index, which ended a run of since March of monthly declines, to actually bounce back quite strongly, with businesses a little bit more optimistic about the next 6 months in the space, and also seeing good business conditions at this moment in time. And the fact that we saw that number vastly exceed expectations as well, the combination of those two pieces of data really did trigger a surge in the US dollar, really exacerbated the move that had already begun in gold. Now, gold had already been moving to the downside. It had already broken key technical support there around 1780, but the move just accelerated after the release of that data. Now, this move that we're seeing in gold is being driven by the fact that we are seeing yields rising, built on the expectation, it seems, that the Federal Reserve is going to persevere with its decision to taper, or its determination to taper later on this year, despite some of the softness that we've seen in recent data and prior to today, and some of the growing risks that we are seeing appearing in these markets. So yields are rising, that's lifting the dollar, and also therefore taking a hit on gold. The break of that technical level, like I say, on the chart there around 1780, what that's done is it's actually broken the neckline of a head and shoulders formation that had been forming over the course of the last month. You can see that the shoulder there forming around $1,810, the head around $1,833 in itself has been a key rotation point, a big point of resistance on 3 or 4 occasions over the course of the last few months, which has been really interesting to see. The break of 1780 then completing the head and shoulders, breaking the neckline, and we really did see it accelerate from there. Clearly, it seems there was some stops being taken out just below there, which accelerated the move, further accelerated again, like I say, by that US data. And already we've seen it break through and find kind of, touch below and find some support around 1750. Now, based on the size of that head and shoulders pattern, that 1750 probably potentially marks the kind of conservative possible price projection target, which is based on the size of the shoulder around 1810 to the neckline around 1780. So that possible price projection from the conservative perspective brings it back to around that 1750 level. So we've hit that level extremely quickly, and that's where we're seeing it consolidate around at this moment in time. If we do see a more significant decline in the yellow metal, then that could give us a possible price projection from the head around 1833 back to the neckline. So a little bit over $50 and projected below. Again, these are only possible price projections based on the head and shoulders pattern, and that would take us back towards the kind of 1730, maybe a little bit below that move if we do see that move materialize. But like I say, it's been a very aggressive sell-off at this point that we've seen so far in the yellow metal, and I think this is really going to be one to watch. If we see a break of 1750, then that really does suggest that the markets are lining themselves up really for the Federal Reserve to either announce something on tapering in September, or at least lay the groundwork for an announcement in November. And I think that's going to be most evident. The market reaction to that is going to be most evident in this FX space. So keep a close eye on the dollar, and quite clearly keep a very close eye on these gold movements, because we've seen some big moves so far, and based on what we've seen so far today, we could see there could be plenty more volatility to come in gold and the US dollar, and obviously US yields as well.